term earnest money or EMD and wondered what it actually means? Let's break it down in simple terms so that you understand exactly how it works in your real estate transaction. Hey, I'm Chelsie Runnings. I'm a California realtor servicing Sonoma and Shasta counties. Earnest money is a deposit made by the buyer to show that you're serious about purchasing their property. Think of it as a good faith gesture, signaling to the seller that you're committed to following through with the deal. It's usually a small percentage of the purchase price, typically between 1% to 3%, and it's held in escrow until closing. Once your offer is accepted, the buyer submits the earnest money, which goes into your escrow account. This ensures that both the buyer and seller are protected. If the deal goes through, the earnest money is applied to the buyer's down payment or closing costs. If the deal falls apart for a valid reason, like a failed inspection or appraisal, the earnest money is usually returned to the buyer. But what happens if the buyer backs out without a valid reason? In that case, the seller may get to keep the earnest money as compensation for taking their home off the market. That's why it is so important to understand the contingencies in the contract. Those are the conditions that allow the buyer to back out without the risk of losing their deposit. So in short, earnest money is a deposit that shows you're serious about your home offer. It's a way to protect both the buyer and the seller and helps make the process and the transaction a bit smoother. Just remember, if the deal goes through, it's applied to your purchase. And if it doesn't, the terms of the contract will determine who gets it. So if you have any questions about earnest money or you want to know more about the home buying process, feel free to reach out. And don't forget to like, subscribe, comment, and share this video with anyone else who's new to any real estate transactions, buying or selling.